Hey everyone, Hunter Satterfield here, one of the partners at Kane Waters, as well as the Chief Investment Officer. As always today, I'm joined by my fellow partner, Brian Bortz, the head of our investment committee here at Kane Waters, as well as our good friend Brad Sanders, the Managing Director of Tectonic Advisors. This is your February market update. For the month of February, the S&P 500 was down just slightly, 0.8%, with global stocks up 1.6%, domestic bonds up 1.6%, and then global bonds up 1.1%. And you can see that that sector rotation that we've talked about over the past few months is persisted, with the S&P actually down and most of the other stocks up. Year to date, small caps are up 7% and internationals up 6%. So it's definitely continuing, which we'll talk to Brad about here in just a second. But first, actually want to start, Brian, with you. Obviously, as we're recording this, we've got a lot going on geopolitically in the world, lots of sort of uncertainty, and I think some of the messaging that we've gotten from clients is a concern with, hey, is this a time where we should actually be pairing risk a little bit in our portfolios? So you want to talk a little bit about what you're talking directly with clients?
Sure. Yeah, that's really kind of the number one theme of the conversations right now is, hey, we've had a really good run. Things have been really good. In fact, we're 41 months into this current bull market that really started in October of 22. So we've had a good run. There's a lot of crazy stuff going on in the Middle East right now. Should we maybe pare back? And our answer as a firm is no. We're very, very comfortable with how we're positioned right now. We've been talking month after month about why our portfolio setups and our allocations are a little bit different than the general market. The Fed is still leaning to be pretty dovish right now. Corporate earnings are solid. Unemployment is low. Inflation still kept in check. There's a lot of really good economic reasons to not pare back right now. So ultimately, our answer is we planned for a lot of things to happen that have happened, and we feel really good about how we're positioned right now.
Yeah, I think much of what's happening in the market is related primarily to uncertainty and maybe things that have ripped harder over the past 6, 9, 12 months and are now pulling back a little bit. But as we remain diversified in our portfolios, we just have a little bit less impact when you don't have a huge concentration to those names. But there are a lot of uncertain things in the world right now, Brad. Obviously with rates and with AI and with everything going on more acutely in the Middle East right now. You want to talk a little bit about how we're viewing that in our portfolios, and then secondarily why we feel like this sort of rotation, more broadly with a broadening of the market, will probably persist.
Yeah, in terms of the geopolitical environment, I mean, Iran is a very explosive place in terms of just how they react to anything that goes on there, and so you're just going to have tremendous uncertainty there. You have the Straits of Hormuz right there, which are kind of shut down. Like 20% of global supply of oil comes out of there. And so we're just going to have volatility, particularly in the early stages of this, until we kind of get a clearer picture of how long is this going to drag on. It could end very quickly, or it could drag on for months, and the market will adjust to that. But over the next, week or two, we're just going to have big risk-off days, big risk-on days. We've managed through those very well. International markets are trending a little weaker than the U.S. because they're much more susceptible to commodity differentials, because they get a lot of their oil. We get more of their oil from that part of the world than we do. And so they're going to be more economically susceptible to stuff like that. So the international markets have been much more volatile than ours even. And we actually saw this yesterday, big risk off in the morning, and then as soon as Europe closed, the pressure came off the U.S. market. So I think as we get more clarity, that'll settle down. In terms of the rotation, what we're seeing now is what I call late stage bubble activity, for lack of a better term. And I'll just marry this up with something that happened early in my career during .com, where you had the narrative towards the end of that was there's not going to be stores anymore. It's all going to go online, and you could buy Home Depot for 3 times earnings in late 1999. Since that period, Home Depot's up 960%, and the NASDAQ's up 500%. So almost double what the NASDAQ's done, and there are still stores. And so what you're seeing now is a kind of a cyclical hit of sector by sector, and it's like, oh, AI is going to take out this industry. It's going to take out this industry, and there's still stores, guys. So what I'm saying is, you just got to stay the course, stay diversified, because nobody really knows what the future holds, and more than likely, this is going to be kind of a slow burn product cycle adoption, like the internet was. And if you stay diversified through it, you're going to end up compounding much better.
Yeah, and you said diversification, and Brian, we talked about diversification on our last recording, right? I mean, that is the core theme of what we're recommending for our clients. What we're doing in our portfolios as we allocate is just staying diversified and making sure that we know what we own, that the things that we own are value based in a lot of ways. And if you do that, no matter what's happening in the world, what's happening with interest rates, what's happening with AI, you're betting on sort of just this broad move higher over time. So that's the theme. We will be back in front of you at the end of March, at the end of Q1, with some good numbers for the first quarter for the year. As always, stay tuned in to our podcast and Brad's weekly message as well that you can gain from get the link from your planner on. Thank you so much. We'll see you at the end of March.